You see the headlines, right? Inflation is cooling. Job numbers are stable. The Federal Reserve, our financial guardians, they tell us they have the tools to manage the economy, to guide us to a soft landing. They assure you the banking system is safer now than it was in 2008. But what if I told you that entire narrative is a structural lie? The reality is, the next collapse will make 1929 look like a minor correction. The next financial crisis will be faster, deeper, and more global than anything we have ever seen. And the single institution designed to stop it, the Federal Reserve, is utterly powerless. What if the true danger isn't the inflation you see, but the $700 trillion of unseen leverage lurking in the shadows? What if the financial elite deliberately move the greatest risks outside of the regulated system, knowing that when it detonates, the Fed will have no choice but to print an amount of money that will obliterate the dollar to prevent a global catastrophe? This unseen mechanism is the shadow banking system and the derivatives time bomb. This isn't about normal market cycles. This is about a structural, engineered failure that guarantees the transfer of the ultimate loss, the loss of your currency's value, directly to you. Before we expose the names and the mechanism, take a second. Where are you watching this unfiltered truth from? Drop your city in the comments. And if you are ready to see why the Fed's tools are obsolete, hit that subscribe button now. The official history of financial crises is a simple story. Banks take on too much risk, the central bank intervenes. But the story of the Great Depression is critical because it set the ultimate benchmark for collapse. In the 1920s, risk was contained mostly within the regulated banking system and the stock market. Leverage was high, but the money flow was visible. When the crash hit in 1929, the Fed's primary failure was one of inaction. They didn't inject enough liquidity quickly enough to save the banks. Now, fast forward to the 2008 crisis. The structure of risk had changed, but its location remained semi-visible. The risk was bundled up in mortgage-backed securities, and the systemic contagion required the Fed to directly intervene with both regulated banks and the shadow banks that held those toxic assets. The Fed invented new tools on the fly to save the system, proving they could stop a collapse if they were willing to socialize the losses. The historical irony is that the cure for 2008 laid the groundwork for the disaster that's coming. Since 2008, regulators forced large, regulated banks to shrink their balance sheets and hold more capital. This was supposed to make the system safer. But where did all that risk go? It didn't just vanish. Greed always finds a way. The risk migrated into the shadow banking system. Hedge funds, money market funds, specialized lending institutions, and investment banks that look and act like traditional banks, but operate completely outside the direct regulatory perimeter of the Fed and the FDIC. They have massive leverage, but zero of the structural oversight. Here's the first shocking parallel. In 1929, the crisis was caused by speculative leverage used by visible actors in the stock market. Today, speculative leverage is magnitudes higher, but it's held by invisible actors in the shadow banking system. Sound familiar? We've solved the problem of visible banking risk by creating a much larger, opaque risk structure that the Fed can't even see properly. The true fuel of this shadow system is the derivatives market. Derivatives are just contracts whose value is derived from an underlying asset, like an interest rate or an index. In simple terms, they are bets on risk. This is the market where the most egregious, mind-boggling leverage resides. And that brings us to shocking parallel number 2. In the 1920s, leverage was about 10 to 1 in the stock market. Today, many large funds operating in the shadow system employ leverage far exceeding 30 to 1 or even 50 to 1, primarily through the derivatives market. This is the same engineered collapse mechanism, but running at hyperspeed. Sound familiar? The moral hazard of 2008 was toxic mortgages. The moral hazard today is the unquantifiable interconnectedness of these derivatives. This system guarantees that the next failure will be worse than 1929 because the contagion is systemic, digital, and completely hidden from view. The key mechanism, the structural guarantee that enabled this global evasion of oversight, involved a specific regulatory loophole that exempted the over-the-counter derivatives market from any meaningful capital requirements. The man who pushed for this deregulation, the figure who successfully argued that these instruments were simply too complex for regulators and should be kept out of the Fed's direct purview, was a champion of financial globalization. This individual successfully argued for the complete lack of oversight over this market, making it the perfect vehicle for risk migration. This set the stage for the current $700+ trillion time bomb. You won't believe the name of the figure who guaranteed this structural immunity and how much wilder the receipt is than you think. Now, let us delve into the weaponized mechanism that renders the Fed obsolete, the derivatives market and shadow banking. The core principle is simple. The financial elite learned that regulation always follows the crisis. So, their solution was to move the risk outside the regulatory perimeter. The derivatives market became the perfect vessel. Derivatives like interest rate swaps and credit default swaps aren't just trading instruments. They are the synthetic glue binding the entire shadow system together. When one large hedge fund fails on a derivative contract, it triggers a chain reaction across all of its counterparties, which are often the regulated banks and other massive shadow funds. This is the structural interconnectedness that guarantees global contagion. Here is a shocking statistic for you. The notional value of the global derivatives market currently stands at approximately $700 trillion. That's more than 8 times the size of the entire global GDP. This disparity proves that the risk is not anchored in the real economy. It's a theoretical, leveraged time bomb waiting to go off. The moral hazard here is extreme. Since the shadow banks are not directly part of the Fed's emergency lending facilities, when they fail, they drag down the regulated banks, who are their counterparties, through their derivative contracts. This forces the Fed to intervene anyway, not to save the shadow bank directly, but to save the regulated banks that are tethered to it. This is parasitic finance. The shadow system generates enormous, unregulated profits during the booms, and when the inevitable engineered collapse occurs, it forces the Fed to print money to prevent the global system from freezing up. And another shocking statistic, during the 2008 crisis, the failure of AIG, a regulated entity, wasn't due to traditional banking risk. It was due to its massive exposure to credit default swaps, a derivative product. The U.S. government was forced to execute a $182 billion taxpayer-funded bailout to cover AIG's derivative losses, proving the systemic threat. The greed of the shadow system is predicated on the illusion that their leverage is manageable. They borrow heavily in the repo markets, often using treasuries as collateral, and invest that borrowed cash in high-yield, complex derivative bets. Shocking statistic number 3. Investment banks, which are major components of the shadow system, regularly maintain leverage ratios exceeding 30-1. That means they borrow 30 times more than their equity. If their assets decline by just 3.3%, they are completely wiped out. This leverage is exponentially higher than the 10-1 leverage of traditional banks. The Fed's primary tool, setting the interest rate, controls the cost of borrowing for regulated banks. But it has no direct control over the funding and counterparty risk of a hedge fund operating at 50-1 leverage in the unregulated derivatives market. They are looking for a visible target when the crisis itself is invisible. And another, the total size of the shadow banking system is estimated to be over $60 trillion globally. That figure is roughly equal to the entire deposit base of the world's commercial banks. Yet it lacks the safety net of deposit insurance and Fed oversight. This parallel system is the epicenter of the danger we face. When the shadow system implodes, the Fed's only recourse is quantitative easing, the printing of new money, to buy up the failing debt and provide liquidity to the regulated banks facing counterparty collapse. This is the hyper-monetization that will destroy the dollar. Our final shocking statistic. Economists estimate that a sudden collapse in just 5% of the global derivatives market could cause a systemic shock equivalent to a 25% drop in global GDP. A scale far exceeding the Great Depression. The lesson is stark. The structural purpose of the shadow banking system was to guarantee a crisis so big it can't be allowed to fail, forcing the Fed into an act of monetary destruction. So, the next crisis won't be stopped by traditional interest rate hikes. The system is operating on borrowed time. The historical lesson is that when private profit and public mandate collide, the public always pays the price. The solution begins not with protest, but with awareness. Stop trusting institutions built on self-preservation and begin protecting your own purchasing power. Buy tangible assets, reduce your debt, and understand that inflation is a feature, not a bug, of this engineered system. We are required to deny that the system is structurally compromised. The very debt that fuels the Fed's existence is the chain that binds the American worker. We must ponder this question of our time. Are we wiser now, or are we just walking the same path in better suits? If you believe that history is not just the past, but an actionable blueprint for finance, share this video widely. Expose this hidden truth to your network. And subscribe immediately, so we can continue to unpack the hidden mechanisms that control your life and your wallet. Thank you for watching.